Hello, hello. Welcome to the Talent Market Index. As folks are filing in, here they come. I've got my green on for St. Patrick's Day. For many years, I was based up in New York as folks are coming in, and boy, is it a day in New York on St. Patrick's Day. So you've now had your fake spring. We're back to cold and snow, but hopefully it'll be back here soon to sunny weather wherever you find yourself today. Just give it here a couple of more seconds as folks are still filing in. My name is Jay-Z. I'm the president here at Talivity, and we are super excited that you're here for the Talent Market Index, our March release. Excited to tell you what we're seeing. We're going to get pretty nerdy today, so I hope you're ready. For those of you that don't know, Talivity is a tech-enabled consulting partner. Tons of data at our fingertips aimed at talent acquisition and HR leaders. We're being curious, looking out around the corner, understanding what's happening in the marketplace and bringing that expertise to your teams, aiming to build stronger brands, understand the trends that are coming your way, and helping our clients put AI to work. So with that, Lauren's already found the clover emoji, but let's get some clover emojis as we celebrate St. Patty's Day in the chat. The chat is going to be open today. I'll be managing that a little bit. If you've got questions or things you want to dig into, we've got some real experts today. You'll get a more formal introduction, but Ben Zweig, the CEO of Revelio Labs, with us today. Excited to have him as we dig into the mixed signals we're seeing, the rising uncertainty, and we get towards the data. So 3 minutes in, let's bring the heat with our Chief Strategy Officer, Mona Tawakkali, as she joins us on the stage and sets us up for the March release of the Talent Market Index. Mona, welcome.
Hey everyone, happy St. Patrick's Day to you all. We are so glad that you can join us today. There is a lot going on in the labor market. There's a lot going on in the world right now, and we all know that you have burning questions about what's happening and how it's impacting the labor market. So you're in luck. We have a great session for you today. But before I get moving with the data, I just want to level set and get you acclimated to what the Talent Market Index is and what it is we track. So, every month we get reports like the BLS Jobs Report, the JOLTS Report, we get the ADP reports. And what they don't track is what it actually costs to attract talent right now based on the current labor supply and demand data. So that's where the Talent Market Index comes in. It measures what employers are actually spending on paid job advertising across 9 key job segments, giving us a real-time view of hiring demand and cost pressure. So when you layer that on top of the traditional data sets, we feel and hope you get a much fuller picture, not just who's hiring, but how hard and how expensive it is to compete for that talent. So with that, let's bring the bottom line up front. 3 headlines you need to know right now. So let's just step back for a minute. This is a really interesting moment in the labor market because, as you can see, the signals are not straightforward, or maybe you've heard already. On the one hand, the February jobs report was a bit of a surprise, honestly. After a strong January, we saw payrolls decline by 92,000 in February. And January had 126,000 jobs added. So obviously that caught everyone's attention. When you look a layer deeper, some of the big context pieces that you should be aware of in terms of what drove those numbers, first and foremost, is healthcare. As we know, healthcare has been one of the sectors holding up the labor market over the past year. And it has consistently driven job growth. In February, we saw a decline of 28,000 jobs in healthcare. I want to note that was largely driven by the Kaiser Permanente strike that pulled more than 30,000 workers out of the workforce. Another thing that's kind of interesting here is, if you were to add the 28,000 jobs that healthcare actually added, The reality is that, what we're looking at here is that healthcare only grew by 3,000 jobs, which is obviously concerning considering demand has been historically much higher. What we're also seeing in the headline number is, distortion. So what we're seeing with the strikes is that the workers didn't necessarily disappear from the labor market; they were sidelined. So we expect those workers to come back in the next report, but is healthcare going to rebound? I don't know. Are we starting to see the impacts of Medicaid? We'll see about that. We're going to ask our experts about that later today. So, kind of next signal that I'm looking at is, broader economic signals that are mixed. We see that hourly wages grew by 3.8%, which is strong. That tells us something positive. We saw unemployment tick up slightly, but we're going to call it flat. It's at 4.4%. And GDP notably slowed pretty meaningfully at the same time. So depending on which metric you look at, you can tell a different story about the market right now. And when we look at the talent market index data specifically, this is where it gets interesting. Even with some of the cooling on the demand side, we're seeing prices elevated almost across the board. So we're seeing hiring demand softening at the margins. The cost of talent attraction isn't following that trend line. We're going to talk a little bit about that on the next slide. So, when you put this all together, we're seeing employers are becoming more cautious, more selective, but it's a relatively expensive and competitive talent environment right now where there is demand. All right, let's take it to the next slide and walk you through the March 2026 release. We're going to break this down by the segment level because that's where we start to see how the macro signals are actually showing up in the market. At a high level, as we go through this, you're going to start to see a lot of arrows pointing up, as I mentioned. We're seeing most segments sitting above the 1 baseline. And also, quick plug for our panelists here. Ben released actually a really good report this morning, and it underscores some of what we've been talking about the past couple of months. So, what he said in his report was that even as overall job postings are coming down, that employers are getting more selective in what they're hiring for, and the emphasis has been on leadership, on experience, and higher impact roles. And we know that those roles do not only command a higher premium in salary, they're also more expensive to attract. So with that context in mind, let's walk through the first few key segments here. Let's start off with finance and operations. This was one of the areas that we actually saw job gains in February of about 10,000, modest, but still considering when we're looking at the broader picture, that's good. And, a second month of growth for this job segment. Pricing wise, we're seeing that it's relatively flat month over month, but year over year, it's up close to 100%. So demand is holding pretty steady for specialized, higher level, senior level talent. Healthcare prices continue to be strong. And just as a reminder, the strikes last month actually impacted primarily California and Hawaii. So, what you're seeing right now is a bit of a clearer picture of the underlying demand. So prices are up 8% month over month and 25% year over year, which reinforces that, obviously hard to fill healthcare talent demand has not necessarily gone away, even though it's gone down. In transportation and logistics, we're seeing some cooling month over month from the peak last month, which is good. But prices, as you can see, are very elevated year over year. That tells us demand has come down a bit, but pricing hasn't fully caught up. IT and related. This is one of the more interesting ones. We're seeing declines both month over month and year over year. This aligns with everything we're hearing about tech layoffs and more cautious hiring in that space, and also, broader investment in AI to replace some of the roles historically done by humans. Also a very interesting topic that we're going to get into with our panel as well. Next up, sales, primarily flat month over month. It's notably up 100% year over year. So even in a more cautious environment, we're seeing, especially in hard to fill markets where labor supply is limited and there's heavy competition, that's where we're seeing prices start to drive up across the board. Retail next up saw a pretty big jump, 38% month over month, 54% year over year. Also notable given everything else going on in the economy and also with consumer confidence coming down. As we see hospitality both down month over month and nearly 50% year over year, which I'm sure for my healthcare employers on the call is a welcome trend. Light industrial moving in the opposite direction, up month over month, nearly 60%, up year over year. So a lot of demand in that segment. And lastly, let's talk about food services. This one we're seeing down month over month. It's still slightly up year over year. But notably, what I want you to maybe pay more attention to is that how significantly it's below the one baseline. This was a category that saw a ton of demand during COVID, and now we're seeing things normalize a bit. That's been a trend for the past couple of years. So that is certainly that added to increased applicant flow in these areas and employers spending a lot of time on streamlining the application process in food services specifically. We're seeing that impact the cost in a positive way. So let's wrap this up. Even though we saw job demand declining this month, we are seeing that employers are being intentional about where they're hiring and who they're hiring for. When you connect that back to the talent market index, it helps explain the pricing and why it's still elevated. Hiring is slowing, but competition for the right talent is still very real. All right, and with that, the moment you've all been waiting for, or I've been waiting for, I would love to welcome our guest panel onto the stage. We have Adam Stafford joining us again as one of our resident panelists. Adam is the CEO of Recruitix, a data-powered recruitment marketing firm known for its AI-driven talent attraction platform. Since joining in 2016, he's held roles from director of product to president to COO and now CEO. And he's guiding the company's expansion across analytics, programmatic advertising, and employer brand strategy. Adam's product-first background keeps Recruitix at the forefront of technology-enabled hiring solutions. Welcome, Adam.
All right, thanks, Mona. Happy to be here.
Awesome. All right, and we have a very, very special guest today. Ben Zweig is a labor economist and the CEO of Revelio Labs, a workforce intelligence company. He is a passionate advocate for understanding the evolving nature of work. Ben also teaches the future of work at NYU Stern. Before founding Revelio Labs, he was a managing data scientist at IBM's Chief Analytics Office, a quantitative strategist at an emerging market hedge fund. He holds a PhD in economics from the CUNY Graduate Center, where he explored occupational transformation and social mobility. He is the author of Job Architecture, Bringing a Language for Workforce Intelligence. Quite a background, Ben. Welcome to the Talent Market Index. Thank you for joining us.
Thanks. Happy to be here.
Awesome. Well, as you all heard, obviously the biggest headline and the punchline from the March 6th jobs report was that there was a loss of 92,000 jobs in February. That was after we were all celebrating in January an addition of 126,000 jobs, thinking that the year of the fire horse was coming in and helping the labor market. But, you can blame it on the weather. Others say it was the strike. Maybe it was conflict in the Middle East. But Ben, let's start with you. Help us make sense of this swing. What is happening here? What are the signals versus the noise?
Yeah, so for sure it was a big miss. I think the average expectation among economists was plus 55. ADP came out a couple days before, plus 63. Revelio actually came out a day before at minus 17. So a little bit more lower, and then minus 92 was, lower than anyone thought. Now, like you said, that was coming off the back of a really positive jobs report in January. And we also thought that January was not so positive either. We thought that was kind of plus 27 or something. And so we thought that was kind of flat-ish, and BLS thought it was not flat. It was still positive. They had one revision downward a little bit. We'll see what happens after their next revision. That might be a revised downward. But the general story is that things are flat. I don't think we should take the BLS payroll numbers as the final word. There are alternative sources of information from ADP, from Rebelio, from BLS, and if you average them together, it's kind of telling the same story. We're kind of flat. Separating signal from noise. So I think the Kaiser Permanente strikes are a big one. That was 30,000 workers, but also it's important to remember that they're deriving these aggregate numbers from a sample. And was the decline from Kaiser Permanente creating more negative signal because that's kind of part of that sample? I don't really know. We don't have a lot of visibility into how these how this stratification works from the BLS side. But either way, it's probably not quite as negative as they're saying, but still negative. And it used to be that plus 150,000 jobs was like a bad month. And now we are far from that. So we are not in a good place. We are still, hiring rates are super low. Separation rates are also super low. You mentioned, wages are up, but we're starting to see some early signs in postings that is reversing a little bit, maybe flatlining. So I think we're not in good shape. Just another note on that is that in previous months, there was this question of whether this is, whether the low additions to the labor market were more supply driven or more demand driven. And I think in previous months, we thought they were more supply driven because, there's limitations on immigration and all that. And that matters quite a bit. But now I think we're seeing some early signs that this is more demand driven, mostly that wage story and declines in hiring rates, I think are more troubling. So I think this does signal some trouble ahead.
Yeah. So, I mean, I guess the follow-up question then is, so, we saw that healthcare, once you factor out the strike data, healthcare was very weak in February and probably the weakest we've seen in a very long time. Do you think that Medicaid cuts are starting to show up in the healthcare job numbers here? Or do you think there's another story that we should be paying attention to?
It could be Medicaid cuts. So I think, I think the story, as I see it, I saw a very convincing chart from, I want to say Jed Kolko, who is another labor economist, comments on these things all the time, and basically plotted the trend of healthcare workers over time since pre-COVID, and it took a big dip since COVID, during COVID, of course, and then we've been on this like upward trend through the recovery, and now we're basically back at trend had COVID never happened. So I think what we have been seeing in the last year, I mean, healthcare makes up for basically all the increases in the last year. And I think the story that he was telling, which I find convincing, is that we're basically playing catch up after the sector had declined during COVID. And now that we're caught up, we won't really be able to rely on these gains anymore.
Interesting. Adam, I'd love to maybe get your perspective here, but I'll start with this. Do you think January was the outlier in the data, or was it February?
Well, I mean, to put a point on the question, I think January was more the outlier. I mean, to Ben's point, we've seen, I don't know, Ben, you used an interesting phrase. You said we're not in a good spot, and I think I would also say we're not in a bad spot, right? Like as an economy, we're in a time of transformation and change. And I think that we're seeing the impacts of technology across jobs where technology impacts the job itself and where there are ripple effects. And when we think about healthcare, right? I'm a little bit, I'm more bullish, I think, Ben, than you are in terms of healthcare continuing to drive growth, but that's more due to demographic shifts than a return to normal. I do think we're at, I don't know if it's this year, is it this year that we're hitting peak 65 from the boomer generation? And so when we sort of eclipse that and that generation starts to age further, I do expect demand for services to continue to drive consumption and ultimately demand for labor. But that said, the roles that respond to that demand, those are the allied health professionals and the clinical roles. It is not the support staff. Across our client base, health systems, just like every other business, are doing everything they can to make their organization more productive. And so we're seeing reductions in workforce in operational staff that are not patient facing. And so some of I think when we look at the BLS numbers, right, the BLS is looking at the kind of organization that is the employer versus the occupation itself. I think we're going to continue to see clinical health occupations and occupations that are patient facing or bedside continue to drive growth, while some of the ripple effects of the adoption of new technology with LLMs and AI in particular, we're going to see reductions in the traditional desk jobs that support the infrastructure of the health system. So, I think to your point, Mona, though, you asked about January. I think January was just as big of a surprise as February, right? If I go back a month and I go like, what did we all feel? We're like, huh, great, right? So, it's almost a little bit manic in nature. But the other like tough part here, I mean, and Ben, you mentioned this as well. Since we're sitting on this razor's edge of growth or decline in the jobs numbers, a shift of 30,000 jobs matters right now. We pay attention to it. 2 years ago or 6 years ago, pre-COVID, we wouldn't have talked about a move of 30,000 jobs in a single sector, right? I mean, that'd be like a footnote to a footnote. And so what that really, I think it's another reflection of the uncertain environment that we're all navigating, where fundamentally what we do for work is shifting if we are a worker who traditionally sits at a desk and works with a computer. The jobs that we're seeing in our client base continue to drive investment in advertising dollars and ultimately in driving applications. Primarily, I should say, all of the ones that are really driving growth are jobs that are done in the real world by humans, pushing atoms around, not bits, right? So, I think I think that we've got a long ways to go to understand what that's going to look like, and it's going to feel uncomfortable the entire time. And I don't know that it's necessarily good or bad yet. It may be good or it may be bad, but I think the discomfort's going to persist.
Yeah, I appreciate your perspective here, Adam. Obviously, Recruitix works with so many leading employers across healthcare and many, many other industries and verticals. And, so I'm really interested in your perspective and what you're hearing from clients right now. What are some of the trends in terms of where they're being cautious, where they're investing, where there's still demand? What's the voice of the customer today?
Yeah, so let me pick out a couple of sectors to kind of zoom in on. We do a lot of work, obviously in healthcare. It's a big part of our client base. Where a couple of interesting just numbers if we look at the trends. So we look at both like overall what are our clients investing in different kinds of occupations. We also look at that on a per job basis. Is the spend on advertising per job increasing or decreasing? Spend on advertising per job increasing tends to indicate either a little bit more tightness and or a little bit higher demand or higher urgency for an employer in a given month. And with healthcare practitioners, I mean, we are coming off of a recent peak, but only a couple percent off that recent peak. And so we're still seeing urgency in terms of employers putting money behind advertising dollars to try and get talent in the door. When we think about some of the roles where we expect there to be disruption, office and administrative support jobs, cooling and significantly down, right, year over year. And so, that's where, we see the broader market in terms of prices changing, but also the intensity of those changes is something that is accelerating in the roles that, I think we expect to be displaced more quickly. Legal occupations, I think, Ben, you talked a little bit about this. Uh, the hiring that's taking place and that is taking place at still a heady clip is experienced professionals. It's not the entry level roles. And So the sector as a whole is declining in terms of investment and new hiring, but there is still strong competition for experienced legal talent, which is supporting prices, right? So anyway, it's few different examples of where sort of we're watching the market at large shift. The Yeah, I think overall, we're going to continue to see these kind of disruptions, and the only place where there's going to be sort of the stability that makes things really predictable is in the markets where uh, talent is hands-on in the value chain.
Yeah, such incredible context behind some of the numbers that we're seeing, in particular on the talent market index side. I'm going to shift gears a little bit here. We will not be able to get through this discussion without talking about what's happening globally right now, including the conflict in the Middle East and rising oil prices. So, Ben, I want to ask you about this one first. How much risk do you think the geopolitical climate poses to the labor market right now? And how do you see that changing over the next 6 to 12 months?
Yeah, so it's a great question, and there's so many channels which this could be disruptive. But one is just through monetary policy. So very often when you get a negative jobs report, the market actually goes up. And the idea there is that, well, maybe the Fed will be more accommodative because they're going to want to lower rates, and that helps capital markets, et cetera. After this negative job market, the market went down a lot by like 1.5% or something, massive decrease. And I think the thought there is that given the rise in oil prices, which are obviously inflationary, that's not allowing monetary policy to be more accommodative. Monetary policy may need to remain tight for a while because they need to we need to get to price stability. There's and that's like mostly true. There's a caveat there that there's still a question about whether this will result in like a level change in prices or a change in the inflation rate. But the conventional wisdom is that oil is so integrated into so much of what we build. It's an input for so many different goods and services that it sort of trickles through the rest of the economy into this sort of price spiral. So it is an inflation concern. But then there's also a question of supply chain risks. Will we get the materials we need to expand production, which is a clear complement to labor. If complements are getting more expensive, then the demand for labor declines. So this is, probably more of like the direct effect. So it's troubling. I'm not like a geopolitical expert, but it's at least from what we're all reading and seeing, it doesn't seem like there's a clear end in sight. So we don't know how long these issues will persist, but I would expect that, we're not going to see accommodative monetary policy. We're going to see rising costs of complements for labor. And another factor is that this is a cloud of uncertainty. And, businesses are already in a risk off, mindset where there's uncertainty about what AI will do, how it will manifest. There's uncertainty around, trade policy. There's uncertainty around, demographic changes, like you mentioned. And now there's uncertainty around, global, the global world order, to put it dramatically. So I think, businesses are probably felt like they were going to kind of stay put and see where things go even before this crisis. And now that effect is even stronger. So I'd say we're not going to see a great deal of investment happening right now, which is problematic.
Yeah. I think to your point, and, if this continues to drag on, which I want to ask you this, and, would love your perspective as well, Adam, which industries are most exposed with energy costs staying high, but then also with the conflict? where's their most exposure? And then, I guess the opposite of that is where do you think there might be opportunity? Ben, let's start with you.
Ooh, it's a tough question. So yeah, I mean, clearly energy, but I would say like construction, manufacturing, sort of the more, the more like capital intensive, resource intensive industries for sure. But I struggle a little bit answering that question because, when I think of those kind of, capital and commodity intensive industries, those are very often inputs into other industries. So, if we think of construction, that affects like, production processes for anything, for retail, for healthcare, for education, like for all these things which don't directly, which aren't like necessarily directly exposed, but, they also need to, produce things, and that are kind of capital intensive. So I would say like the first order effect would be on these like commodity intensive, capital intensive industries, but there could be second order effects in the rest of the economy that could be as large.
Yeah. Adam, I'd love to hear your perspective here, but more specifically, if you can also talk about how do you expect this to impact talent attraction prices, and what do you think we're going to see in the TMI as well?
Yeah, so I mean, it's a good question, and much like Ben, I mean, there are a lot of things wrapped up in the impact here. I think I'll start with the easy answer. Our clients in aerospace and defense are all increasing their investment and looking for innovative new ways to attract talent right now. And so, for careers, if we think about some of the decline that we've seen in IT and related fields, folks who move from the private sector to the public-private partnerships that really drive aerospace and defense could see a lot of opportunity moving, from a role that was traditionally in the civilian sector to one that's a little bit more related to supporting the government. So there is some opportunity being driven here. I mean, I think obviously energy production as well, the demand for talent, for experienced talent in the field, and that'd be whether that's offshore or onshore in production is certainly those prices are going up. Um, Now, I think if we think about okay, let's kind of take the easy ones aside and get a little bit tougher. As we start to think about supply chains and in particular internet like North American multinationals that have parts originating in Europe. I think we're going to start to see some disruptions in the European ability to produce OEM parts. That's going to hit in particular like scientific instruments and some high tech companies that you may think of as North American, but that use a high degree of components that are sourced in Europe. Europe's very exposed to the current crisis and the impact to energy in the supply chain. And I think going a little bit more broadly, uh, the North American services organizations, probably end up being the ones where we see the least impact or the latest impact. Some of the knock-on effects, if their clients are starting to feel the declines that are driven by upstream supply chain impacts overseas, eventually they will contract for services, that are a little bit more cost effective. But I think those ripple effects are going to take kind of take months to play out. So,
Yeah.
I think you asked me, Mona, what does this do to talent attraction prices? I mean, what this ends up doing, the North American economy in particular, very, very services heavy. We're going to continue to see high competition for talent and high prices for experienced talent. And I think we're going to continue to see depressed prices and a lack of demand for junior talent. And that's going to create a whole nother host of issues for the economy, in the next 5 to 10 years that we're going to have to wade through as well.
Yeah. So prices are not cooling down anytime soon, is what I'm hearing, and need to get creative in ways that you attract that more senior level, high in demand talent that's maybe already employed, and you're trying to get in front of them. So obviously, really, really good conversation as well. Not to shift it back to more negative news for the month, but last week we saw the U.S. GDP growth for the fourth quarter was revised down to just 0.7%. For perspective, pretty sharp slowdown from the 4.4% growth in the previous quarter. We've also seen consumer sentiment drop along with that. So, Ben, if I'm a talent acquisition leader, today on March 17th, 2026, help them make sense of all of this and the combined signals. Is all this slowing growth and consumer confidence weakening? What do you think that means for hiring demand in the next 6 to 12 months? How should TA leaders be proactive right now?
Yeah, look, I mean, it's not good news, but I think it's the same story. I don't think we should extrapolate too much from these GDP revisions, because ultimately, GDP is a function of labor and labor productivity, and we know that labor market, we know what's happening to labor markets. We know there's a big decline, and we know that this conflict had an effect on capital markets, which also factor into GDP, but they're a little bit more speculative. So we are seeing some just general declines in like presumed economic activity, sort of predicted economic activity. So that's troubling. But the positive story is that we are seeing productivity growth, and if we expect that labor markets will kind of stabilize around this point, which who's to say, but I think we'll keep tracking these ups and downs, but at least we are seeing increases in productivity, sustained increases in productivity. So I think that really is the flip side of this, that productive capacity is not as weak as the just raw nominal headcount. Like we are producing more per person, and that is probably the effect of AI. I know we'll probably have more to say on AI, but yeah, I think it's a positive story. And there's this saying in economics called Say's law. It basically says supply creates its own demand, which is a simplified version of a lot of different theories. But basically, I think the gist of it is that in the long run, really in the medium run as well, the health of an economy is based on its productive capacity. And we are as labor markets loosen, we probably will see productivity growth for who is actually like in the labor force, and then those remaining workers will be more valuable on the margin. So I wouldn't be too nervous just based on the GDP numbers alone, because they are happening at the same time as meaningful productivity growth.
I appreciate you bringing a silver lining to the discussion, Ben. Adam, I know you were at IM Phenom last week and probably talking to a number of TA leaders while you were out there. What advice did you give them when you were chatting with them?
Oh, well, yeah, when we think about talent attraction and talent acquisition professionals in particular, we were at a great conference in Philadelphia put on by a partner of ours, Phenom. They've released a lot of very innovative technology recently that, again, it makes the TA team more productive. Now, there's two ways to think about that. One is great. A TA team can add more capacity and do more with the same head count, which means you don't need to hire more TA folks to help you hire more people for the rest of the business. Now, net, that's a good thing. That is an increase in productivity, though that can disrupt, an industry that historically has been very human driven, very human process centric, right? And so as technology takes on many of the tasks that used to be performed by recruiters or by sourcers, what that means is that the demand for those particular skill sets are going to shift. Now, I think those skill sets are very, very applicable in other markets with high demand. And I also think that there's a lot of companies that, as they grow, are going to continue to hire recruiters. So I don't think it's necessarily bad for the industry. But point being, the talent leaders that attended this conference were there with a certain purpose, and that was to find technology that could make their teams and their organizations more productive than their competition. And so, when, Ben, I, love the silver lining, or, just the fact that, yes, I do agree with you, supply does tend to create its own demand. Um, the, the punchline in talent today is that the actual people who are really at the forefront of their field and their careers in talent acquisition, um, they're becoming adept at different things, or they're learning different skills and different technologies than leaders of the past 5 to 10 years. And so what we're seeing is that the folks that we work with every day are much more interested in data. They're much more interested in technology. They care deeply about their teams and the humans that they're hiring and that they're bringing into their company, but they want the facts that data can give them that show that they're producing quality hires and that they're doing it more productively year over year.
Well, both of you opened the door to AI, so we're going to go there. Ben, I'd love to ask you about this, because I know that you do a lot of research and speak a lot of thought leadership about AI and the impact of it on the workforce. So my question to you is this: is AI showing up in the hiring demand data already? What should we expect for the rest of the year?
Yeah. So the short answer is it is. It is high. It is showing up in demand, but in unique ways. So one thing to note is that AI, or really any technology, does not automate jobs wholesale. It automates components of jobs. So you can think of a job as a collection of tasks, a bundle of tasks. And if we look at kind of AI exposure at the task level, we're actually seeing dramatic declines in the tasks that are most exposed to AI, on the order of 30%. So that is a massive change in like what is being demanded in the labor market. Now, that doesn't mean we're seeing a decline in those jobs. So some of this transformation of what we're seeing demand for is happening within job, and some of it's happening between jobs. And mostly it's happening within jobs. So mostly the jobs themselves, what people are doing, is changing very quickly. But the actual roles being hired, the types of people, the types of jobs being advertised for, that's not changing that dramatically. Now, there are some ways that is changing. So I want to focus on that. I don't want to say everything's totally fine and neutral there, because we're seeing a divergence in the demand between older and younger workers, experienced and non-experienced. And we are seeing much more dramatic declines in non-experienced workers and junior hires. So junior workers are in trouble, and they are like they're having a very, very tough time. A much tougher time than you would have predicted given the general state of the economy. So, just personally, when I graduated college, this was in 2009, like the height of the financial crisis, and unemployment rate was like 10%. And now unemployment rate's like 4.4%. But for younger people right out of college, it is a worse labor market today than it was when I graduated college, when the unemployment rate was 10%, which is a wild state of affairs. So huge differences between junior and senior workers. And part of that reason is this conservatism that companies are really prioritizing the short term. And a junior worker is just a more uncertain bet. It is a bet that takes a longer time to pay off. Whereas if you want results tomorrow, the much safer bet is paying a premium for someone with experience. So I think part of it is just, the risk profile of companies is changing. We're in a risk-off environment, but part of it does have to do with AI. That I mentioned before that you can think of a job as a collection of tasks, but to get a little bit more nuanced on that, a job is the execution of tasks, and it is also the orchestration between those tasks. So, when you join a job, you're hired to do a bunch of things, but you are also hired to decide what comes first, what comes second, what are the dependencies, who do you need to work with on this or that. You need to manage complexity, and older workers have more experience managing complexity, and there is a premium to management, coordination, orchestration, leadership, whatever you want to call it, this whole jumble of things, which means, being able to, coordinate in a complex environment. And that is something that more experienced workers have, are better at. So I think that's a real effect. And, we'll see how more junior workers adapt, but that is definitely showing up in today's labor market.
Yeah, I appreciate that perspective. And maybe after this conversation, we'll talk a little bit more. I have 2 kids in high school, and I would love to know what industry you think I should get them into.
Yeah.
But I know that we're getting short on time here, and I want to just allow you both to share any closing thoughts. It can be about what would make you more optimistic about the labor market right now, if we've reached the bottom of hiring. Anything that you want to close out on that we didn't touch on yet? Adam, let's start with you. We'll let Ben wrap us up.
Yeah. So Mona, thank you. I think a couple of things that I looked at earlier today was really looking. You had floated this question to me last week, like if we hit the bottom in hiring, and hiring, flat is kind of the key word here. And so, hitting the bottom maybe in terms of growth, perhaps. But I think as we look at some of the longer term trends and we kind of expand from jobs reports and certain, single industries and expand out to job openings and unemployed persons, I do think that we're seeing continued growth in the unemployed people in the raw numbers, and especially on a cumulative basis. When we look from the beginning of January 2025 through the end of February this year, the growth in unemployed persons, unfortunately mirrors the decline in job openings. And so those two things are not necessarily cause and effect, but they're certainly negatively correlated and almost directly inversely correlated right now. And so when we think about the hiring market, it's going to be uncomfortable. It's going to be uncomfortable for a while. And Ben, you highlighted a number of different sources of uncertainty. I'd throw in one more to your list: immigration. And the immigrant labor pool in the U.S. is also full of uncertainty and volatility right now. And so it's not a real heartwarming message, but it's kind of a tough message. Like collectively, we've kind of got to eat our Wheaties right now, and in that means that we got to bear down and buckle up and push through. And it's I have a ton of confidence in the American economy and the global economy in the long run, but it's not going to feel like winning right now, and it's going to take a while. And sometimes those wins that don't feel like wins, where it's like, I don't know, this is a personal story, but I'm a lifelong Seahawks fan. The Seahawks went to the playoff one year on a 7-9 record. That didn't feel like winning, right? And they had lost in the playoffs after beating Dallas, which was great. But point being, there are times when winning isn't going to feel like winning, and I think we're going to be in that sort of feeling within our labor markets and within fundamentally hiring for the next 12 to 24 months. There's going to be the wins, but we got to recognize them for what they are, even when they don't feel the way that maybe things felt a few years ago.
Very well said, Adam. And currently adding Wheaties to my shopping list for tomorrow. Ben, close us out here. What are some parting thoughts with our audience?
Yeah, I would say, one thing we're trying to track very closely is the extent to which work can kind of reconfigure. Because, with changes in technology, with changes in policy, I think there is, the world around us is changing. The demands on our businesses are changing. The worker profiles are changing. And some firms will be able to adapt and some will not. one thing I'm a little nervous about for healthcare is that there are very strict occupational licensing requirements. It's not easy for jobs to transform in that environment. I think the smart, innovative firms will find a way to make it work, but a lot of them won't. And I think we will be tracking the extent to which, jobs can transform. Maybe that can be done through top-down leadership, through middle managers. There are a lot of mechanisms where work can change. I think we're seeing a lot more companies get serious about tracking the work activities involved and the skills required to complete those work activities and changing around their talent strategy. I think we're seeing more firms experiment with offshoring. That probably has a lot to do with immigration restrictions. So I think there are companies that are trying different things, and I think that is great. In volatile times, we should be experimenting as much as possible. So I think part of that is like changing locations where you're sourcing talent, the types of occupations that you're employing, the work that each occupation is doing. There's a lot of ways to adapt. So I think it's going to be the adaptive organizations that make the most of our current situation. And yeah, we'll be tracking that and cheering everyone on in the sidelines.
Yeah. Incredible advice and wisdom. Adam, Ben, I can't thank you enough for such an incredible conversation. Thank you both for your time and sharing your wisdom with the audience today. With that, I'm going to bring Jonathan Zila, or Jay-Z, back onto the stage to close us out.
All right. Thank you, Mona. Always a
Thank
pleasure.
you.
Thanks, Ben.
Always feels like I'm in trouble when somebody calls me Jonathan Zila, Mona. So, well, what a session today. I am hopeful. I'm curious. I'm ready for next month's TMI to see where we continue to see the signals and read those through the noise. You can grab your phone, quickly sign up for next month's session here with the QR code set for April 16th at 1 p.m. Eastern. We're excited to have you there. For any of you that are going to be at Transform next week, please stop by our booth. We'd love to say hello to you, and maybe we can dream or doom scroll. I don't know, however you're feeling, but we'll be there and we'd love to meet you at Transform. And we'll see you back next month, April 16th, 1 p.m. Eastern, for the next release of the Talent Market Index. Thank you for being here today. Grateful to have you along for the ride, and we'll see you next month. Thanks, everyone.